And go. Welcome to the FU Show. Today we're going to talk FU as in FU money, thus investing. And some of these companies are clearly in my backyard: Google, YouTube, Snap, Facebook, Twitter, and TikTok. So let's just dive in. Last year in 2020, it was the first time ever that Google actually broke out YouTube revenue. So in 2019, YouTube actually generated a whopping $15 billion that year. Now, to put that into perspective, CBS did about $6 billion, NBC did about $5 billion, and Fox and ABC each pulled in about 3 to 4. So already by 2019, YouTube was crushing it. Now, last year, when the Q1 started, YouTube came out of the gates, and I was blown away with how strong they were pulling in revenues year over year. March 12th, my birthday, is when the pandemic shut everything down. It was kind of the peak of advertising revenue, and it kind of fell, and the bottom was probably April 1st. Why? Some campaigns that were in the system in Q1 either got shelved right away, or once they were ended March 31st, they never got renewed April 1st. But slowly but surely, things started to accelerate again. Why is that? If you are selling ads for BuzzFeed or Vice, it's a more high touch point experience. You got to go meet your marketers, your media planners, your media buyers. It's not as efficient as programmatic advertising, which is what drives Google and YouTube revenue, be it in search, display, or video. So YouTube is actually quite sheltered and will benefit from COVID because the lack of live sports, the lack of new programming on TV, and a lot of brand safety issues is going to basically never bring back the lost ad dollars on TV. They're just going to accelerate, break the dam, flow from TV to places like YouTube. So last year, it was actually impressive to see quarter over quarter YouTube go from $4 billion a quarter to $5 billion a quarter. Sequentially growing revenues at that scale, 25%, is an insane amount. YouTube ended up closing 2020 with a staggering $6.89 billion in revenue, which isn't surprising, again, because there's just more, people still are promoting their goods and services, and it's just a lot easier to run this through YouTube and Google. So not surprisingly, they renamed Google Preferred YouTube Select. It was the same results. And the fact that they have opened up more pre-rolls and mid-rolls and post-rolls, reducing the minimum total running time of a video to be eligible for mid-rolls from 10 minutes to 8 minutes, just opens up so much more inventory and places for brands to run their ads. So I still see tremendous upside, obviously very biased through WatchMojo being on YouTube, very biased by virtue of owning some shares, but I think Google and YouTube will dramatically outperform going forward in ad sales because the ad dollars that were on TV are going to flow faster to our friends over at YouTube. Facebook's challenge remains the same. I think Facebook needs to decide what is the goal of video in their empire, right? Facebook is super successful. Video is one of many things. I also think they need to determine what is the role and the raison d'etre of Facebook Watch. I'm going to guess more people still watch videos through the feed. And while we had like a great year growing on Facebook, not surprising that, switching gears, Snap emerged as our second platform. So when Snap started off, it was obviously the messaging, communication tool. It's now evolved into a phone company. They had the filters, which drew a lot of marketers because it was definitely beyond the banner. And I think when they launched Discover, they basically first went out there and they got the big marquee brands like New York Times and Vice to provide programming. And this was early on when the ad model within Snap was probably a bit too embryonic. The results maybe were a bit underwhelming. And so as the New York Times and the Vices may have lost a little bit of interest, it created kind of like what happened on YouTube and opening in a vacuum for WatchMojo. We filled the gap, and 2019 was really a lot more about experimentation. I visited them at their partner summit and proceeded to buy shares because I was blown away with how much marketers and CMOs loved Snap. It's as if Snap did a Venn diagram of what marketers did not like about Facebook and what they did not like about YouTube, and they nailed it. So after launching their marketplace, it created higher demand and thus higher effective CPM rates, and that's why throughout the year, Snap was just crushing it. Now, Facebook's boycott, I feel, disproportionately helped Snap. Why? Because Snap is seen as brand safe. So not surprising to see Snap have a solid year, but because Snap is more embryonic, then they don't have this kind of automatic renewal year over year where brands are necessarily guaranteeing them a certain spend. That is why they cited disruptions in Q1. And this is what I was telling my team, saying we experience and Snap experienced such year over year growth that we shouldn't expect that out of the gates, but over the second half, they will benefit. To wrap off, Twitter, huge in search live, could be huge in video live. Unfortunately, they don't seem to necessarily execute and nail that opportunity. TikTok obviously remains the wild card, still very much embryonic. If you're interested in more, follow me on Clubhouse because, hey, why not? Under the Context brand, and we'll probably do a little bit of a dive and bring some people to discuss these different platforms with me.